Hello, I'm Emma Morgan, Portfolio Manager at Morningstar Investment Management Europe. Welcome to our Q4 2019 Market and Portfolio Update. Shares rallied in late 2019 to cement a strong year of gains across major equity markets around the world. Looking back over one of the stronger years on record, the common catalyst was the influence of central banks, whose support came in response to sluggish growth. However, the global economy proved more resilient than many expected as the year wound to a close. This, coupled with trade fears subsiding and greater clarity regarding a potential Brexit outcome, sent shares to record highs in many parts of the world. Bond markets also saw strong returns through 2019, although this ran out of steam as the year came to an end. Looking across all asset classes, equities had another good quarter, with a strong December boosting returns. In contrast, global bonds and UK gilts gave up some of the gains generated earlier in the year. Against this backdrop, all but our most cautious portfolios produced positive returns over the quarter and delivered strong absolute returns for 2019. Within equities, the UK market led the way, following the result of the general election and greater clarity over the future of Brexit. Emerging market and Asian equities also posted strong returns as geopolitical concerns eased, with the US and China reaching a Phase 1 trade deal. The worst performing markets in sterling terms were Japan and Europe ex-UK due to the strength of the pound. As we look ahead, we maintain a preference for developed world ex-US equities over the US market, in particular the UK and Japanese equity markets. The UK equity market offers an attractive valuation on a medium to long-term basis and has been out of favour with investors. We have a lower weighting to US equities, where investors are paying unusually high prices for unusually high earnings. We introduced exposure to Korean equities in our more adventurous portfolios over the quarter. Whilst sensitive to cyclical high earnings and trade tensions between the US and China, valuations more than reflect these concerns. Turning to fixed income markets, global government bonds retraced some of the gains from the first 9 months, with yields rising and prices falling, as better economic data supported risk assets. The best performing assets were global high-yield bonds and emerging market denominated in US dollars. As valuation-driven investors, we continue to prefer emerging market over developed market government bonds. That said, the strong returns we have seen from these assets over the past year has resulted in yields and our expected returns for the asset class falling, and we have been trimming back allocations in this area. We also favour US government bonds over UK gilts due to the extra yield offered and their defensive nature. As 2020 gets underway, we continue to focus on delivering the maximum amount of return for a given level of risk, as opposed to just generating returns without regard for the risk taken in achieving them. Ultimately, our process looks to identify unloved assets that we think will help deliver investor outcomes over the longer term. I hope this gives you a good overview of the portfolios and positioning, and thank you for watching.